Sorry. Siguro wala nang mic. Okay lang. Yeah. Alright, so good afternoon, everyone. And thank you for coming, our known foreign guests. Again, thank you for having me. This is my second time presenting a paper. And if you can still remember, last year, March of last year, I presented this paper entitled Which Came First, the Chicken or the Egg? What about ducks? So this year, I am planning to continue the tradition of presenting serious, mind-boggling, thought-provoking, norm-challenging, and most importantly, knowledge-advancing topics. And so this year, I'm planning to present this topic. Who really came first? Adam or Eve? Ranger Pasali using heaven. So, for those who don't know me yet, my full name is John Francis Diaz, and you can just call me. Anyway, this is just a joke, of course. So, my presentation is about comparing two sets of companies. First one is your ethical companies and unethical publicly listed financial corporations. So the formal title of this paper is Return and Volatility Performance Comparison of Ethical and Non-Ethical Publicly Listed Financial Services Companies. So this title just meets the requirement of 15-word title. That's the So again, congratulations to the officers, especially to our president for having this third scholars forum. This is my Chinese name, by the way. Tabibo lang. Okay. So let's have the background of this paper. So did you know that there's this growing awareness of the investing public with regards to socially responsible investments, or SRI. And these are investments in enterprises with high ethical values and very efficient corporate governance. And in line with this, there's also increasing investments in stock portfolios related to CSR initiatives. So people, or the investing public, that's really loving ethical or responsible companies. So if you don't believe me, I'm going to be showing you a data. This data is from 2010 to 2014. And I think they are yet to release the 2016 data because they are updating every 2 years. So from 2010 to 2012, assets of socially responsible investments grew by 28.08%. And from 2012 to 2014, this grew by 75 or almost 76%. So from 2010 to 2014, there's this 125 increase in the assets of socially responsible investments. Right? So, on the other hand, if people are loving socially responsible investments, there's this rising disappointment against non-ethical financial companies, especially during the recent subprime mortgage crisis, because they are at the center of the problem. And financial companies, they have this high involvement, particularly those big institutions, the likes of AIG, Lehman Brothers, Bank of America, Goldman Sachs, etc. So because of these trends, I was motivated to do this paper because of the growing interest of the investing public in adding ethical public listed companies in their stock or equity portfolio. So aside from this motivation, I also noticed that there's this absence of studies comparing the predictability and volatility symmetry properties of ethical and non-ethical financial companies. So when I say predictability property, you are determining the predictability of a particular set of time series data. I'm going to be showing you the data in a while. So you just run the time series data in the software, and then they will release a number, and from that number you can tell if this particular set of time series data is predictable. Okay. So what about this volatility asymmetry properties? So let's have this very, very simple illustration. When we say symmetry, or when there's symmetry, we have this figure. We have equal amount of space right here and here. So the first and second quadrants. But if we have asymmetry, this side is small, obviously much bigger, and this one is small. So how do you relate this with the volatility of oil and gas instruments? So imagine that in good times, or in a good economic conditions, returns of investments are steadily growing. Right? Steadily growing. However, during bad times or during recession, the returns of those investments immediately or suddenly goes down because of the panic, because of the shock, right? Because people are intentionally suddenly pulling out their investments, right? So that's your volatility asymmetry. So aside from this motivation, there's this obvious literature. There's this obvious limited literature on financial ethics topics, given the financial ethics is a relatively new academic discipline. So these are the objectives of this paper. So first is to find out which group of financial services companies, that is your ethical and unethical companies, has higher returns and steadier volatility. This objective answers the question, do ethical financial companies have higher returns and lower volatility because of this recent trend? Because if people are investing regularly or constantly to this ethical companies, then we should expect higher returns and, in a way, lower movement in the stock or lower volatility. So for the second objective, we will determine the predictability property of the stock returns volatility. So this will answer the question, are the time series data predictable through its volatility? So the third objective is to check for the presence of leverage effect and volatility asymmetry phenomena. This answers the question, are ethical companies safe haven investments? So when we say safe haven investments, can you have a whiteboard to illustrate? Oh, there, we have one. Okay. So when we say leverage effects, in good times, normally the volatility is like this, quite steady. However, in bad economic conditions, volatility increases and becomes unstable. Right? So when there's this leverage effect, that means the effect of bad times is being increased. There's this leverage effect. And in times of good times, the volatility is steady. So leverage effects and volatility asymmetry phenomena is in a way related, because in times of good economic conditions, the returns are steady. However, in bad times, it will go down. Okay? This is because of the increased volatility. People are losing. So the last objective is to examine which type of models for short, because I am comparing short and long memory models. So when we say long memory models, these are models that has this additional coefficient and equation that it can predict a particular time series data. So the long memory model is assumed to be more powerful than the short memory models. So this answers the question, are long memory models better because of more flexible computation? So well, this is actually statistics. So, but in the literature, you're considering long memory models as a better model compared to short memory models. So, contributions. So the obvious contribution of this paper is to provide an additional literature regarding ethical and non-ethical financial companies. And then this can also aid your fund managers and traders in devising trading strategies in relation to returns and volatility. And then in the academe, of course, this can provide additional knowledge and offer new research insights or avenues regarding this problems. These are just blah blah. Okay, for the literature review, I divided the literature in 3 groups. The first one tells us that ethical investments are good investments. So for example, this one, asset managers with this study of De and Clayman said that asset managers with high environment, social, and governance or ESG ratings experience higher portfolio returns over low ESG ratings. And the second set of literature review is that they're saying that ethical investments are not so good. They're not performers because they have this many conditions in selecting stocks or equities. And because of those conditions, or in the screening fees, the total returns for those ethical investments are not so good, or in fact, lower than your average portfolio. So for example, this one from Bauer, returns of SRI funds underperform in general because of excessive screening fees. And in fact, one study of Hong and Kasperzeit says that since stocks or those companies those companies that are related with the production of vices like tobacco, alcohol, they're actually experiencing higher expected returns, especially during times of recessions. Okay? Well, the possible practical reason is that in times of recession, when you're under stress, you tend to cling on to these vices to make it last.
Agreed.
So I guess most of us here, when we're under stress, we do more research.
Makes you stress, he wants more research.
See, when I'm under stress, I run data. Right? Alright, so the good, the bad, and this is the neutral findings. Right? So this study found that there are no significant differences in returns among ethical and conventional funds, especially among these advanced markets. So let's now go to the data and methodology. So for the data, I used daily closing prices of stock prices from July 1, 2009 to April 9, 2015. So this paper, this is already a published paper actually. And I'm supposed to present this paper last year. That's why the data is quite old. And I also presented this paper in an international context. I am presenting this because this paper won of the best paper ever.
So you cannot press.
You can just accept it.
Alright, I'm just laughing. Okay, for the data, so this is, for example, this is the Yahoo Finance website. Yahoo Finance website, and this is the data for AIG, which is one of the data that I used for this study. And these are your closing stock prices. So you will download this and get the logarithmic natural log returns. Right? These are the natural log returns. So this is now your data. So this data will be, you will use this data in the software, to run the software. So from this, you you will have numbers and interpret those numbers. Okay?
Why do you have to transform?
Transform.
Bakit kailangan mo
Log returns. Sige nga sa libro. With the log returns, your data experiences a smoother series. Right? And the later with the filtrations, I'm going to show you that the data that I use is stationary, free from unwanted data problems. So these are the list of ethical publicly listed companies, which is based on the research of this particular organization, Atmosphere Institute. Annually, we are providing us a list of ethical companies around the world. So I selected only those financial services companies for this study. So in the list, there are actually 13 ethical financial companies. 7 of them are publicly listed or traded in stock exchanges, so you can have the data. So you can download the data. However, out of those 7 publicly listed companies, 3 did not pass the initial data filtrations. I'm highlighting filtrations because you can also use flirtations. Because when you filter the data, you are in a way flirting with your data. If you can use the data or not in your study. So this is their counterpart. These are the unethical or non-ethical financial corporations. So the basis of this selection is from this article. This is the source of ethical companies, and this is the source for the non-ethical companies.
But they have criteria.
Yes. They have very stringent criteria in screening these companies. Okay, so that's the data. So let's now go to the methodology. So the methodology models your return and volatility. So this is the model. This is the model. This is a short memory model that captures the return and the volatility of a particular time series data. Yes. This is the autoregressive function, and this is the moving average function. Okay. So this is the long memory model counterpart. So you will notice that from ARMA, you now have your Arthema. You added fractionally integrated. You added the fractionally integrated function. The fractionally integrated function is represented by your D exponent. Okay. So the D exponent will tell you if the data if the data time series is predictable or not. So this is your short memory model. This is your long memory model. And this is an additional short memory model for the volatility. And we are interested in your gamma parameter. So this represents the volatility, asymmetry, and leverage effect. So this is the extension with the fractionally integrated function. So we are again interested with the D, with the long memory property, and the gamma. Okay, if the gamma is negative, that means your investment. That's
Ba't ang
my
bilis?
Again.
We didn't
So here, if it is a negative number, that means your stock price or your investment is in a way steady. In good times and in bad times, they react in the same way. So they are called safe havens because when you invest in these investments, during the good times, you expect that your returns will not fall suddenly. So if they are symmetric, then your returns or your losses will be experienced in a gradual manner. your gamma is negative. Right? So this are safe haven investment. So we've been talking so much about long memory models, short memory models. What about long-legged models? Ouch, ouch. Yeah, this is the usual awkward moment. Okay, so a negative numbers means or stands for safe haven investment. If it's a positive number, this is the characteristic. Alright, so these are the empirical results. So this is just your typical data statistics. So I will just discuss the relevant numbers. So for the mean, these are the returns. And for the average mean of ethical companies, this is 6.23%, which is quite high for an investment. Okay. And for the standard deviation, the volatility is 1.89. So when you compare these numbers with non-ethical companies, the average mean for the average return for non-ethical companies is 3.78. So take note that ethical companies have higher average returns, right? And for the volatility for non-ethical companies is higher. Okay? So there. So we can now say that ethical financial services companies have higher returns and lower volatility because they have higher average mean and lower average standard deviation. So what can we get from this result? Maybe portfolio managers in the future can consider picking or investing in socially responsible investments because they have higher returns and steadier volatility. Alright, so this is your data filters. So this means that this one means that the data is stationary. This one means that your data is free from serial correlation problems. And this one means that your data is free of heteroscedasticity or unconstant variance. Explaining this is as difficult as it's spelling. Okay, just unconstant variance. So same here, we have similar results. The data is clean from this problems. So let's now go to let's now answer the next objective. So for this, we have the ethical companies. This is the short memory model. This model is being compared to the results of the long memory model. Okay. So we are interested in the volatility. Okay. So the volatility coefficient, D coefficient, is not present in the short memory model because of the fractional integration parameter aspect of the long memory model. So this means that the data has this long memory property. The data is in a way predictable when you use its volatility. So this is just the beginning because there's just another step for forecasting. And this study did not cover it. This study just determines if the data time series is predictable. And this is also similar with your non-ethical companies. They have long memory properties. Okay. So this is related with the second objective. Are the time series data predictable to its volatility? Yes, because of the positive volatility coefficient. Okay, so this is now your symmetric volatility properties, or this question is related with the safe haven properties. Are you feeling that I'm doing a lecture? Am I boring you now? Okay, so
We're thinking.
We're researching about the
We're
companies.
thinking for some questions.
Watch out.
Okay, because unfortunately I can no longer polish this paper because it's already published. This paper.
Fortunately, you can.
Anyway, for future studies, Alright, these results are related with your. So I'm just going to do this. So this results are related with this, the third objective. Are ethical financial services companies safe haven investments? Are they special? No, they are not special. They behave in the same way with your non-ethical financial companies. So the stocks of ethical financial companies are quite similar in behavior with your common investments. So what's the deal with this finding? That means portfolio managers or fund managers cannot expect that ethical investments will save them in times of recession. Okay? But there are investments that have a symmetric volatility characteristics. One is gold, and the other one is platinum. These are relatively safe investments. They are, in a way, immune to negative shocks. I know this because I also have a paper regarding those safe haven investments. So that's it. So for the last objective, this is related to the log likelihood criteria. So when you have higher values, that means your term model is better. So since I am comparing short memory models and long memory models, so you have to look if the log likelihood values of the long memory models are higher compared to the log likelihood values of the short memory models. So from these findings, consistently, the log likelihood values of the RF model, the long memory models, are higher compared to the short memory models. So when you use a model, you might as well just use the long memory models to model your time series data. So there, those are the objectives. So for the conclusion, I'm just going to repeat those four main objectives of this time. So for the return and volatility comparison, I have mentioned a while ago that ethical companies on average have significant high returns and lower volatility compared to their non-ethical counterparts. Okay, and for the long memory properties, which is consistent with the second objective, so historical values of stock price returns can be used to predict their future values through modeling the volatility. For the, this should be number 3. Sorry. And for the asymmetric volatility properties, both ethical and non-ethical financial services companies' stock returns are not immune to negative shocks, or not immune to bad news. So in times of recession, they will be all negative. What, Carla? Okay, so for the last objective, long memory models are better compared to the short memory time. Recommendations. So obviously, you must still include SRI and CSR related investments because of their relatively higher returns and steadier volatility. Okay? And then, however, investors should not consider ethical financial companies as safe haven investments. Huwag sila masyado umasa. Sorry. Okay. And then lastly, technical analysts should consider, even researchers like me, should consider the potential of long memory methods. Because long memory models are relatively new in application. There are very, very few experts like me who are applying this kind of models. Alright, so there you go. That's my paper.
Huwag daw kayo magtanong.
Thank you. Happy CSR investing. Okay, good.
Thank
you, our expert financial.
Analyst. So may I now call Miss Christine Tuliao for her presentation.